What do you think are the investor expectations for the fixed income market in 2011?
I think that investors should expect softer returns for both the fixed income market in investment grade as well as in high yield in Asia. When I say this, I would like to clarify that I mean the US dollar bond market or the hard currency bond markets of Asian corporate issuers. And I do expect that the returns would be softer than what it was last year. As far as the risks are concerned for the Asian corporate bond market, there could be a combination of macro risks as well as idiosyncratic risks that could affect issuers within this region. Obviously, as everyone is aware, the macro risks include largely the issues we are seeing in Europe, whether it is with the sovereigns and the bank bail-ins, or with the more recent geopolitical issues with the Middle East and Africa. Now, our base case and my own personal view anyway is that I don't expect to see fundamental concerns in the Asian corporate bond market or Asian sovereign space based on these concerns. But what we do have to bear in mind is what is investor reaction to this in terms of taking risk off the table. And our base case is that because income expectations of investors continue, we do expect to see continued inflows into the region, though probably not of as high a scale as in the past year. The second other risk that could eventuate is that of idiosyncratic risk, whether it's in terms of M&A, it's in terms of shareholder activity, or even in terms of corporate governance risk. And this is a little more difficult to categorize, more difficult to predict, and more difficult to even handle because the impact on prices could be much more severe. And this is something to be wary of. As regards the credit ratings of companies here, we have conducted an in-depth analyst survey both on the equity side and on the fixed income side on our credit side, and the analysts do come back with a very positive and benign view as far as the fundamentals are concerned. And based on themselves, whether in terms of the expectations on their business profiles, or even their financial profiles, we don't really expect too much ratings movement. We are in Asia quite sanguine about credit profiles of corporates in the region, both in the investment grade and in the high yield. On their own, we don't expect too many rating changes, mainly because the top lines and bottom lines are expected to be supported. And this has come through very strongly from the analyst survey we conducted a few weeks ago. What's going to be interesting is to see what happens to the individual companies' strategies, financial strategies. Most of them have cashed up over the last 2 years and therefore have very strong liquidity, and this has also come through very strongly from our analysts. What they will do with this cash is what is going to be most interesting going forward. Are they going to go into more of M&A, or are they going to go into more of a shareholder return type of strategy, or even return debt or deleverage? That's what's going to be quite important for us to see what is the impact on ratings. As such, we do see from individual issuers' point of view, there are idiosyncratic events and impacts that could change ratings, but this could be in both directions, to be honest. It could be from investment grade to high yield, or it could be high yield to investment grade as well. But this is due to individual investor strategies. In terms of issuers in the market, what we are seeing that's rather interesting is two things. One is that in the high yield side of things, the diversity in the issuer base is increasing, both in terms of the country where they're coming from and in terms of the sectors they're coming from. In terms of the investment grade as well, while in the last 2-3 years, the issuance was mainly from the banking sector, over the last year and in fact in the last few weeks, we get the sense that we will see a lot more issuance in the investment grade corporate sector, and this could be in single A space, and it could also be in triple B space. So essentially what we're really seeing is an interesting time, an interesting opportunity for investors to invest all across the spectrum, whether it be from high investment grade, high quality names to slightly more opportunistic and more yielding names in the investment grade as well as the high yield sectors. In terms of the investor profile, what we've seen in our high yield fund, for instance, is that we are getting a fairly diversified investor base over the last year or two. Our fund is the highest it's ever been at over 2.2 billion, and the investors are coming from everywhere. They are from Taiwan, from Europe, from Hong Kong, from Japan, of course. So we've even got clients from South America. So essentially, this is a very strong affirmation that the Asian corporate sector is very much doing well and doing fine. And at the same time, it does signify that, or it does really point to the fact that investors are looking for income. And we do expect that, given the under-allocation to this asset class, this will continue going forward. Having said that, we do expect, and we would be fools to ignore the volatility. And in the high yield side of things, the volatility is probably higher. And so from a risk-adjusted point of view, maybe investment grade is the place to be. Having said that, Asian corporates do still represent fairly good value, both because of their credit quality as well as because of spreads, which are still not at their tight levels they were in 2007 before the crisis.
What yields do we expect from the fixed income, and why?
Obviously, the returns in 2011 are likely to be softer than the previous 2 years. That's my personal view, and that's largely because of what we're seeing on government risks as such. In the last 2 years, the significant amount of monetary loosening and the interest rate policies being quite generous have to change at some point. And so we are expecting that this year could see some rise in yields. But at the same time, credit spreads are still fairly attractive relative to what they have been in 2007, 2008, just before the crisis. And so we do expect positive returns, but lower returns than the previous 2 years. For instance, in the investment grade side of things, we expect mid-single digit, and in the high yield, it would be around the mid to high single digit. Overall, we are quite sanguine, but we do expect volatility, and therefore lower returns overall for both these asset classes.